How do short-duration bonds compare to high-yield bonds? Are you curious about how short-duration bonds stack up against high-yield bonds? Let's break it down in simple terms. Short-duration bonds are fixed-income securities with maturities usually between 1 and 3 years. This shorter time frame means you get your principal back sooner, which helps reduce exposure to interest rate risk. When interest rates rise, bond prices typically fall, but short-duration bonds are less affected by this because of their quick turnaround. These bonds are generally less volatile, making them a safer choice for those looking to preserve capital and maintain liquidity. While they offer lower yields compared to longer-term or riskier bonds, they are appealing for banks and credit unions. They help manage liquidity needs and keep asset value stable, especially when interest rates fluctuate. On the other hand, high-yield bonds, often referred to as junk bonds, are issued by companies with lower credit ratings. This means they come with a higher risk of default. To attract investors, high-yield bonds offer significantly higher yields. These bonds typically have maturities up to 10 years and can be callable after 4 or 5 years. While they also have relatively low duration, their prices are more sensitive to economic conditions and corporate earnings than to interest rate changes. When comparing the two, the risk profiles differ greatly. Short-duration bonds usually have lower credit risk and interest rate risk, making them more stable. High-yield bonds, however, carry higher credit risk and can be more volatile, especially during economic downturns when default rates may rise. In terms of yield, high-yield bonds provide a much higher return to compensate for their risks, while short-duration bonds focus on capital preservation with lower yields. Interest rate sensitivity is another area where they differ. Short-duration bonds are less affected by interest rate changes, while high-yield bonds are influenced more by economic outlook and credit conditions. For banks and credit unions, short-duration bonds are a conservative investment choice to manage liquidity and reduce interest rate risk. High-yield bonds can be used to enhance yield and diversify credit exposure, but they require careful credit analysis due to their higher default risk. There is also a special category called short-duration high-yield bonds. These combine features of both types, offering shorter maturities than typical high-yield bonds while aiming to deliver attractive returns with lower volatility. This can be a great option for banks and credit unions looking to diversify their portfolios without taking on too much risk. In summary, short-duration bonds prioritize stability and liquidity, making them suitable for conservative investors. High-yield bonds focus on higher income potential but come with greater risk. Understanding these differences can help you make informed decisions about your investment strategies.